You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well for this Retirement Friday. I'm recording this, and there's a little bit of snow is falling still, and we're in the spring. Anyways, just had to share with that for a second because I don't know, that kind of changes my mood when I record. Retirement Friday. Today, we're gonna talk about how to set up a portfolio. $3 million, want to generate $84,000 a year in dividend. Yes, you're gonna tell me, wow, Mike, you're pulling out some big numbers here today, and it's kind of a good problem to have, an easy problem to solve. I'll agree with you, but I wanted to do the deep dive into the mechanics of generating income from such a portfolio, mostly because it came as a question from one of my private webinars that I done earlier in March, and I thought, well, that could be interesting to talk about the mechanics, and then you can change the numbers after that. I mean, whatever numbers that we're going to talk about is some people are going to say, but Mike, it's just ridiculous numbers. But here we are, $3,084,000 a year in revenue from that $3 million. So the classic, we're going to talk about three different ways of doing it. And finally, we're going to talk about what will I do with my portfolio when I come down to retirement? Because of course my yield is closer to 2% than anything else. So is it going to be enough for me to retire on, or am I going to change anything in my portfolio? So we're going to talk about that at the end of this show. So starting way, well, of course, this one is kind of an easy way to do it because you can use it the classic way. Classic way, $3 million, you build a dividend portfolio at a 2.8% yield, and then boom, you got your $84K per year in dividend. Even better, at 2.8% yield or 3% yield, chances are you are able to build it with a long list of companies that are well diversified and that are able to grow their dividend every single year. So that would protect your portfolio, your capital from inflation. So the 3 million would stay there. The 3% yield, super easy to generate, and making sure that this dividend payment of $84,000 increase every year with a 3% yield, not a problem. And then covered inflation, all things is good. One thing to keep in mind though is that 3 million is in a non-registered account. Well, then if you focus just on yield, you may get into, if you have other sources of revenue like CPP, OAS, and the likes, chances are you're going to get hit by OAS clawback because you're going to reach the OAS clawback limit at probably with the grossed up dividend if you have a lot of Canadian dividend stocks as well, just to keep that into consideration. So what if you have a little bit less than 3 million, but you still need that $84,000 a year that you want to generate, and you would need a little bit more than 3% yield? So there is the classic way, and then there's what I would call the DSR way, the way that I intend to invest at retirement, actually. More on that at the end, of course, of this show. So having the $3 million, but investing it in strong dividend grower. So maybe the yield would end up anyway around 3%. Maybe it would be higher than that. Maybe it would be lower. The point would be focus on quality companies with robust metrics and not include the yield in the decision factor. So if the yield is 1%, but the company is great, you understand the business model, the dividend triangle is very strong, so you have a constant flow of increasing sales, increasing profit, increasing dividend, then I would take it. If you go through the same analysis and then you end up looking at a company like Exchange Income Fund that we have discussed yesterday, for example, IEF.to, or a larger business such as a Canadian banks offering a 4% yield or a 5% yield. Right now, you have some interesting banks offering this, or Canadian Natural Resources offering a long streak of dividend increases plus a very generous yield. Well, there you go. You can add it to your portfolio as well because you do not use the yield as a decision factor. You're just focusing on quality companies that is able to grow first, and then second will also increase their dividend. So that would be the two cases. And then how you can generate the income from such a portfolio if the yield is too low, well, then you use a cash reserve. So you have like a mix of selling shares during good years and then using the cash reserve during bad years, because the sequence of withdrawals is super important. If you have a year where your portfolio is down 15%, this is probably not the right time to sell some shares, right? So having some cash on the side to bridge the gap between the dividend that you receive and how much you need to sell in shares, that would be very like the perfect scenario. So cash reserve and then a mix of like selling shares and like getting the dividend that you generate from that portfolio. So that is the what I would call the DSR way. Actually, if you wanted to learn more about how to set up your portfolio like this, which is a lot safer than focusing on high yielders, you can download the Dividend Income for Life guide at moosemarkets.com/income. So moosemarkets.com/income for the Dividend Income Life. I actually explain how you can set up the cash reserve and create that mix of income, which is a little bit better for taxation, a little bit better in terms of like the life expectancy of your portfolio, because you focus on quality and not on yield, and it makes it easy to not having to sell during the market is being down. So there is another option between the classic way and the DSR way, is the way that you like ends off way. You don't want to focus too much on investing and reading financial statements. Well, you might as well just invest in a well-diversified ETF. Personally, I prefer like the all-in-one type. It's a little bit more like, it's not perfect, but what I like about the all-in-one ETFs is they would fit with my asset allocation. So if I want to have a little bit more bonds or a little more equities, you can find like the right one for all of those. So you start with XCQT, for example, by iShares, that is 100% equity, and then you can go to the other series of that that ETF, all in one ETF, but then they include bonds and preferred shares. What I like about it is you invest in like 9,000 holdings for XEQT. It goes up above 20,000 holdings, including bonds. Cannot be more diversified than that, right? And then every month you're just withdrawing some shares, like a mix of like dividend and shares. You can use the cash reserve and then you're good. I would probably not necessarily focus on high yielding ETF, especially if you go above 4%. You know, in financial planning, if you count on withdrawing more than 4% of your portfolio, no matter how you structure it, like high yield stocks, covered call, name it, it goes against the fact that chances are at one point the dividend will not increase with inflation. You'll be forced to sell shares or something like that. And withdrawing like 5, 6, 7% from your portfolio is too much. So eventually you're going to have like, you go into a risk of seeing your portfolio value decline and surviving your portfolio. So that's why the rate of withdrawal usually safer below 4%, higher 4%. Don't believe that because you're making some different strategies, it's going to work out. Most of the time when there's a crisis, there are some problems. So you have to be very, very careful about that. But having said this, investing in ETF would definitely work. A lot easier. If your spouse is not too interested into investing in the stock market, that could be a good way to say, hey, honey, you just have to follow that ETF and then you sell shares once I'm gone and it's going to work. That could be interesting. Now to finish the show, would I change anything to my portfolio retirement? Absolutely not. First, I've been building and managing this portfolio using the same strategy for now 15 years, since 2010. It has gone through a lot of market cycles, some crisis, some bear markets, and it went very, very well. So I don't see the need of fixing something that is not broken, even if my situation changed where I'm going from the active phase to the retirement phase. I still count on that portfolio to grow and generate income. As I mentioned earlier, using the DSR way, is focusing on quality businesses. Once I have quality businesses, I'm convinced that they're going to go through whatever downturn is going to happen. It could be tariffs, it could be recession, could be inflation, could be higher interest rates. I don't really mind about whether the future reserved for me. I know that the portfolio is really strong, well diversified, and the quality is better than anything else. So even if the yield is lower, the only thing that I'm going to change is I'm going to create a cash reserve to create that mix. Once again, if you're curious about how you can set that up, you can go to moosemarkets.com/income, and you're going to be able to download the dividend income for life guide that explains you how it works. All right, Moose, that's enough for today. Not tomorrow. Tomorrow is Saturday, so we're off. But I'm going to come back on Monday, and I'm going to tell you why I love Constellation Software so much. Until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.